Welcome back to an early edition of Power Lunch today. And why are we early? Because the markets close in 4 minutes, as you can see there. So let's bring you right to that point with Tom Lee. We brought him back, and he has some stocks that are making his nice list this holiday season. They're going to kill me in the back. But, Tom, we have to start with something that everybody's lighting us up about since we talked to you 45 minutes ago, which is do tell us about crypto, okay? ETH, they want to know what's your target there. Bitcoin, what do you do with it? It's the one thing that's not part of this melt up that Steve's been observing here.
Yeah, well, crypto was having a good year in 2025 until October 10th, and suddenly the paths of crypto and gold and risk assets diverged. I think as we look back at that moment, there was a liquidation event that was similar to 2022 when FTX collapsed. So it took 8 weeks for markets and market makers to sort of recover and markets to begin to find their bearing. I think that's what's happening now. The outlook for crypto is still really good for the next 5 to 10 years. I don't want to overuse the word super cycle, but we know that Wall Street wants to tokenize everything, whether that's Vlad at Robinhood or Larry Fink at BlackRock. And that's going to bring a lot of efficiencies to Wall Street, but it really brings the use case forward for something like Ethereum. So we're pretty bullish. I think Ethereum, which is around 3,000, can easily get to 9,000, 7,000 in early 2026. And then over time, as it starts to be competitive with payment rails, could get to the 20,000 level. So I'm pretty bullish. I like Bitcoin. I think Bitcoin is suffering from gold envy right now.
Yes.
And that liquidation event, gold's been a great asset, now at over 30 trillion. But I think, again, Bitcoin is a genuine store of value. It is supply limited. So I think in next year is really when Bitcoin can sort of begin to recover, and the 200,000 level makes a lot of sense to me.
So let's pause for a second, because if what you just heard from Tom Lee plays out, the next question becomes, how does the market actually get there? We're talking about scenarios where Bitcoin pushes toward $200,000 and Ethereum enters the 5-figure range by 2026. And that's exactly where Matt Hougan's macro view starts to matter. Crypto hasn't had an easy path. Years of regulatory pushback, uncertainty, and stalled institutional participation slowed adoption. But that backdrop may be shifting faster than most people realize. Think about what's lining up. A political environment moving toward regulatory clarity. Major financial institutions like Merrill Lynch, JP Morgan, and Wells Fargo opening the door to Bitcoin exposure, and large pools of capital, including university endowments, beginning to treat digital assets as legitimate allocations. These aren't short-term narratives. They're structural tailwinds. And when you view the recent pullback from previous highs not as a breakdown, but as a market reset, it reframes the setup heading into 2026. That's why next, we're diving into Matt Hougan's perspective to understand the macro forces that could quietly build the foundation for the next major phase in Bitcoin and crypto.
I think the 4-year cycle is being replaced by a 10-year grind, by which I mean there are big new forces in the world. They started coming in with the launch of the ETF in January of 2024. They were accelerated by regulatory progress in January of this year. We have the growth of stablecoins and tokenization. I think those forces are bigger and stronger than the forces that historically caused the 4-year cycle. So specifically, I expect the market to be up next year. And so therefore, from that perspective, I think the 4-year cycle is quote unquote dead. I still think it matters because it's in people's minds. I think it's one of the reasons prices have been suppressed this year. But do I think we're in a 4-year cycle? No, I think we're in a 10-year grind upward of strong returns, not spectacular returns, strong returns, lower volatility, some up and down, but I think next year will be up. And so I guess from that perspective, I think the 4-year cycle is quote unquote dead. And we are seeing lower volatility, right? Bitcoin is now less volatile than NVIDIA for the past year, which is a remarkable development. I do think this distribution from retail to institutional is happening, right? Harvard is buying and retail is selling. It actually plays into that idea of predictable irrationality, or whatever the exact term Sebastian used, which I love. I do think part of the reason we're down this year is you have fast-moving retail crowd that is rotating out in anticipation of that 4-year cycle. And counterbalancing that, the reason we're down 30% and not 60% is you have this persistent, slow-moving institutional buying that's keeping the market up. I think that's probably going to be a common pattern for the next few years as this distribution happens. Maybe like a staircase up and then an elevator down is an experience that we could have in crypto, because you have these two people who move on very different time frames. I'll just add one more fun fact from Bitwise's perspective. I think the institution is just sort of hitting its stride. I don't think crypto is used to how slow those institutions moved. As two examples, we just now had the big four wirehouses, Morgan, Merrill, Wells, and UBS, approve Bitcoin products, even though the ETFs launched in January. So we're just opening the doors. The other experience from Bitwise's perspective, our average institutional client allocates after 8 meetings. If they do meetings on a quarterly basis, and they started when ETFs launched, they're just getting to their 8th meeting now. So I do think you have this slow-moving force and then this fast-moving retail trade, and I think that explains a lot of what's going on in the market. I think there was a one-time effect of the Trump administration on Bitcoin. The effect was simple, which is, if you asked institutional investors in previous years why they weren't investing in Bitcoin, the number one reason wasn't volatility or valuation. It was actually regulatory concerns. We did a survey every year, and that came back loud and clear. And I think one effect that the new administration, new regulatory environment did for Bitcoin was clear the air. They made it a safe asset for institutionals to invest in. And I think that was helpful. I agree that now there's not much more that they can marginally do for Bitcoin. It's in sort of the regulatory clear, and the bigger effect is downstream on other crypto assets. I do think people are looking at the macro conditions, and that will set the term for whether that's a major driver or not next year. I'm not sure, but I do think that matters more than any incremental regulatory efforts specific to Bitcoin.
Now, you guys make great points, but just to kind of beat the horse a little bit more.
Yeah.
What about when Trump, for instance, said something like, the Fed earlier this month cut rates about a quarter basis point, and then Trump said they should have cut rates more, right? They should have cut rates at double how much they did. Does that affect Bitcoin?
Well, I mean, my general view is that people overestimate the impact of interest rates cuts right now on the crypto environment. The reason is, in the past, we were living in this world of extreme yo-yo swings on interest rates. We had interest rates crash to zero, and then the fastest hiking period ever, and then crash back down, and then right back up. Now we're talking about marginal 25, 50 basis point changes. I don't think they're as important as they were in the past. It certainly matters. It matters who the new Fed chair is, right? There are sort of two leaders in prediction markets. They have different views on the role of the Fed. That will definitely have a short-term impact. It matters incrementally what decisions they make from a rate cutting perspective, but I don't think it matters as much as it did in the previous cycles. I don't think it matters as much as it did in 2018, in 2022, because the scale of marginal cuts or increases that we're talking about is so much smaller. It's a contained set. Bigger difference is what those two chairs would do from a QE and monetary perspective, as opposed to the interest rate side of it, because I think they're relatively aligned on lower rates, and therefore it may be more priced in. I think they have different views on the broader role of the Fed from a liquidity perspective, and I think that's where the marginal difference will be. And then the other piece of that is, what will Treasury do if we hit a difficult economic perspective, right? Are we going to get things like stimulus checks or other forms of monetary easing? I think that mix will be the nuance that influences where crypto goes next year.